In 2022, US stocks fell 19% and bonds fell 13% at the same time. Your portfolio lost on both sides simultaneously. That is not supposed to happen. And most people still do not know why it did. Here is the part nobody explains. The 60/40 portfolio has a trigger, a specific set of conditions that causes both sides of your portfolio to move in the same direction instead of opposite directions. When that trigger is active, your diversification disappears exactly when you need it most. Right now, in May 2026, that trigger is sitting at 3.3% US inflation, and the threshold that activates it is 3%. Here is the mechanism. The 60/40 split works on one assumption. When stocks fall, bonds rise and cushion the loss. This is called negative correlation. It is the entire reason you hold bonds at all. But that negative correlation only holds in a specific environment. When inflation is low and stable and the Fed has room to cut rates in a downturn, in that environment, bonds behave as a hedge. Outside of it, they do not. Research tracking nearly 200 years of market data shows that when core inflation runs above 3%, the stock bond correlation turns positive. Positive means both assets move in the same direction. That is exactly what happened in 2022. The Fed raised rates aggressively to fight inflation. Rising rates pushed bond prices down. Falling earnings expectations pushed stocks down. Both sides of a 60/40 portfolio dropped together. The result was a loss of 17.5% in a single year, the worst performance for the 60/40 portfolio since 1937. Now, here is what I want you to understand clearly. The 60/40 recovered. In 2023, it returned 17.2%. In 2024, roughly 15%. In 2025, roughly 15% again. That is real and it matters. But here is why those numbers do not close the conversation. The recovery happened because inflation fell. As inflation came down from its peak, the stock bond correlation normalized and the hedge started working again. The strategy did not prove it was safe. It proved it works when inflation is below 3%. We are currently at 3.3%. And here is the number that almost nobody talks about. Even across that entire period, from 2021 to 2025, bond investors barely broke even in nominal terms, while losing nearly 23% of their purchasing power to inflation. Your bonds returned almost nothing in real terms across 4 years. So the question is not whether 60/40 is dead. It is not. The question is whether you understand the specific condition under which it stops protecting you and whether that condition is present right now. The condition is inflation, specifically inflation that forces the Fed to keep rates elevated. When rates stay high, bonds lose value. When inflation squeezes corporate margins, stocks lose value. Both happen at the same time. That is the failure mode. And right now, US inflation sits at 3.3%. The Fed has made zero rate cuts in 2026. The OECD is projecting global inflation at 4.2% for the year. The 60/40 framework was built for a world where inflation averaged 2.8%, and the Fed had room to cut aggressively in every downturn. Between 1982 and 2021, that is exactly the world we lived in. Bonds cushioned every equity drawdown. The strategy returned around 9% annually over 40 years. It was one of the most reliable frameworks in the history of investing, but the reliability came from the environment, not the formula. The formula has a condition. Most people were never told the 60/40 only works reliably under specific inflation conditions, because for 40 years those conditions were never seriously tested. They were tested in 2022. The portfolio lost 17.5%. It recovered when inflation fell. Inflation has not fully fallen. The trigger is not fully off. So, What do you actually do with this? Three adjustments, not panic, not a total rebuild. Three specific changes that reduce your exposure to the trigger. First, check your bond duration. Most people have no idea what duration their bond fund carries. Duration is how much your bond loses for every 1% rise in rates. A fund with duration above 7 years is carrying significant rate risk right now. Dropping to shorter duration bonds of 1 to 3 years cuts that exposure sharply. Nobody told you to check this. Second, ask whether your bonds rise or fall with inflation. Standard bond funds lose value when inflation runs hot. That is the opposite of what you need when inflation is the problem. Treasury inflation, protected securities move with inflation instead of against it. That is not a complicated switch, it is a direct fix to a specific flaw that is active right now. Third, understand that where you are in the macro cycle determines whether your 60/40 is working or quietly failing. Right now, you are in a high rate, sticky inflation environment. That is historically the environment where the 60/40 underperforms. Most people running this allocation have no idea the environment they are in changes the rules. The question is not whether the 60/40 is broken. The question is whether you know what breaks it, whether you know the trigger, and whether your money is structured for the environment you are actually in right now. Most people are not. That is exactly what the next video addresses. This video is for educational purposes only and does not constitute financial or investment advice. All figures and examples shown are for educational illustration only. Past performance does not guarantee future results. Individual results will vary based on personal circumstances. Nothing in this video should be construed as a recommendation to buy or sell any specific security, fund, or financial product. Always conduct your own research and consult a qualified financial professional before making any financial decision.